Welcome to Opto Sessions, where we interview the brightest minds from the stock market, uncovering their secrets to success. If you're looking for ideas, tips and techniques from the world's best, you're in the right place. Hello everyone. On today's episode, Brian Shannon, founder of AlphaTrends, will help raise your trading game as we dive deep into the psychology driving price action in the markets. Why do technical indicators work? And how can you use this knowledge to help you find great trading opportunities? Brian will also reveal how he's enhanced his trading using technical analysis on multiple timeframes. So without further ado, here's Brian. Hi everyone, I'm Ed Gotham and this is another episode of Opto Sessions. We're lucky today to have full-time trader Brian Shannon, the founder of AlphaTrends, on the show with us. A swing trader for over 30 years, he's also spent time at some major investment houses such as Leeman Brothers. Brian founded AlphaTrends in 2010. I believe that's right, Brian?
Yes, that is.
As an online community providing swing trading analysis and education. He's also the author of a highly regarded book, Technical Analysis Using Multiple Timeframes. It's great to have you on the show, Brian. How are you finding the markets at the moment?
Well, it's great to be here, Ed. Thanks. I have to correct you. Actually, it was 2006 that I started AlphaTrends. But back to your question, the markets, we've got this amazing volatility. And for someone who is into short-term trading, this is where, you really thrive. Although we're starting to maybe see a little bit of slowdown, it's been a great environment if you can be disciplined and keep your thoughts of what the economy might be doing versus focusing on price action.
Yep, no, completely. I thought it'd be interesting to start with how you got into the world of trading, a bit about your background. Obviously, you've been doing it for a long time. It's always interesting to know the story about how you got there.
Yeah, sure. I mean, I started out actually back in the late 70s, early 80s. I used to hang out with my dad, and he would watch Wall Street Week on Friday nights. I really didn't know what was going on there, but started picking up certain things, and then asking questions to my dad, and had an interest in the markets. So that kind of really is what got me interested at first, because he had had investments, and he would tell me about what he was doing a little bit and the rationale and that sort of thing. So it just kind of evolved from there.
And then you had a career in the financial industry then before you went into full-time trading. How long have you been doing full-time trading yourself?
Well, so I graduated college in 1991, and I thought at the time I wanted to be a broker. I thought being a broker was being a trader. I guess I didn't know the difference. So I learned that being a stockbroker was actually a glorified telemarketing position, and that was not what I was interested in. I had some early trades as a young adult that really got me hooked on the interest of the market, and I wanted to trade. I didn't want to be a salesman. I wasn't really a natural salesman, but I did learn at Leeman Brothers some great sales techniques that have worked well for me since then. So it's been a great process.
That's brilliant. And what about it is that attracts you to trading specifically?
I think that it's the intellectual curiosity, knowing that you can be wrong on things or right. You also have the independence that, it's to me, it's an individual sport. I know some people think, well, it's a team sport and you want to, have a network of people, but I really tend to get distracted by other people's opinions, and have learned over time to trust, my analysis of the market, and then work on my mental state of mind, the discipline part and the psychology. That's really what allows me to be in this business as long as I have been.
Yeah. And how did, along your journey, what led you to focus more heavily on sort of technical analysis and swing trading?
That's a great question. I had originally, after graduating college, I had been made a habit of going to the local library and reading the Cabot Market Letter, which those guys are still around. That I just found them maybe a year or so ago on Twitter, which is interesting to see. But they had mentioned a stock that was of interest to me. It was called Advanced Polymer Systems. APOS was the symbol. And they, in their newsletter, they said they wanted to buy it above $5 per share, and I think it was about 470. And I was thinking, well, why would you want to pay more for this thing? It just, that doesn't make sense. So they actually had a chart, on the next page, and then it made complete sense right then and there why it would move. I didn't really know why it made sense, so I went out and I bought Stan Weinstein's book, Secrets for Profiting Bull and Bear Markets, and that has had a huge influence on my career in terms of the way I look at the market. So it was just that really kind of the one sentence, we want to buy it higher than where the price actually is right now, that got me interested in technical analysis.
And that is, can you what did you find out exactly why that was? Like, why do you want to buy it higher than the price is now? Is that because of some technical setups that look?
Yeah, so for that one in particular, I remember it had a long base where it had just been doing nothing. It came up to five, maybe a half dozen times over the previous year, but was unable to get through it. So and the range was tightening. It was making some higher lows. I didn't realize all of this at that time, but I realized that I didn't know what the term resistance meant, but I could look at the chart and see, $5, it's not able to get through there. But if it does, it just made sense that it would be able to continue to move higher, because I guess I recognize that, there's a seller there that they need to move out of the way. And if that seller would move, then the price was free to go higher again. And what actually happened with that trade, it went on to, I bought it, I think 505 or something like that, and sold it about 6 months later, which was a short-term hold back then, but kind of longer term for me now, at a double. So I was hooked and started just reading everything I could about technical analysis, because it made so much sense beyond the story that they were talking about. They had mentioned price action in a way I'd never seen before.
Yeah, that sort of segues into my next question I got here, which is that you commonly use the phrase "only price pays," which refers to price action. And it'd be interesting for the audience if you could possibly go into that in a bit more detail. We could learn about also how that relates to buyers and sellers in the market, etc.
Sure. I started realizing that the market doesn't care about my opinion. I used to read, devour all kinds of value line, which was a thing back in the day. I don't know if they still have that, and just read research reports and even annual reports. And I would feel like I really knew a company well, and I would go to buy it and the stock would go down. And I started thinking, well, all this research, all this wasted time, and here I am, losing money on this, and I thought I knew it so well, and I would, make the classic mistakes of averaging down. The market's wrong. How could the market get this wrong like this? And I started reading headlines, and it started occurring to me that, one of the first things, when I was 18 or 19 years old, I read something about a company who was laying people off. And then the stock went up. And I was thinking about it saying, well, I intuitively at that point, I thought, well, that doesn't make sense. Their business is weakening. The stock should go down. And then I realized, I dug into it. Well, wait a minute, this is good for their business because they're cutting costs and that sort of thing. That it's not the headline that matters, but it's the reaction to it. And we have egos and we place a high value on what we think the market should do. But if we get stuck in that mindset, and the stock starts going against us, it's going to be very frustrating, and we're going to be losing money and arguing with the logic of it the whole way down, just like we have right now. This market is up 30+%, off the COVID lows, and we're seeing record unemployment. We're seeing businesses still shuttered, and things that just seem so bad for the economy. But if you just listen to price action, you would have moved out of any short positions on the way down, as it started rallying, and then start to look at recovering stocks and saying, well, maybe I don't trust them, so I'm going to trade smaller share size. But price is moving higher. I don't want to argue with price action because I know who loses in that battle. It's going to be me, not price.
Yep. So, in essence, would you say that fundamentals behind stocks or even economies are just less important to what's happening on price action, basically what's happening on the charts, which is basically the market of buyers and sellers, and that's given us the indications of how to position ourselves.
I would agree with that, in particular for this shorter term time frame. There's a phrase that it's attributed to Warren Buffett that is, in the long term, the market is a weighing machine. In the short term, it's a voting machine. So in the long term, it weighs all the evidence and all of the fundamental factors that come into play. But in the short term, it's emotional. It's a vote. It moves about quickly. So for my time frame, which again is swing trading, I don't really have to know the news so much. I want to be aware of potential catalysts that come into a stock, like earnings are coming out, or I want to know a catalyst for the market, like a jobs report or the Federal Reserve, and then just make sure that there's still a way for me to manage risk around an event. And if I can't manage that risk properly, then to be on the sidelines in cash and wait patiently for things to be more clear in terms of where do I see my edge.
Yeah. Okay. And I mean, it's probably a difficult one to answer, but at what point do you think fundamentals become more important in decision making? Are we talking like 1 year time frames plus?
I think that if you're going to hold things for more than probably 3 months, because at that point, now you're talking about earnings reports.
Yeah, yes.
And you've got to get through an earnings report. And if you can get through an earnings report and still have your position intact, then that's what you want to be aware of the fundamentals, because sometimes these stocks will run up with no fundamentals at all, and then as the news is released, it'll sell off completely, buy the rumor, sell the news type of thing. So I think anything more than probably a 3-month hold, you should be doing a lot more fundamental analysis than what
That's
I
fair.
currently do.
And when you're swing trading, what sort of assets are you typically focusing on?
Mainly U.S. stocks. So U.S. equities, they've got to trade an average daily volume of at least 500,000 shares a day. And I look at a 20-day average for that. And I do trade some ETFs as well. And I do some scalping in the E-minis when there's just too much volatility in the stocks, but there's where they're not set up properly, but there's a lot of volatility in the market overall, where I can get in and out of there quickly because you've got such great liquidity.
Yeah. And maybe you just answered the question, but you mentioned a minimum sort of volume. Is that down to liquidity? Is that the reason why you look for a minimum volume?
It is, and I also, so at AlphaTrends.net, I make suggestions for people each day, and I don't want to bring ideas to a group of subscribers where the average daily volume is 200,000 shares, and we're moving the stock. I don't want to be someone who is has the ability to move a stock based on what I say. I want to react to what the market's giving and go based on that.
Yeah, makes complete sense. And for your swing trading now, what sort of time periods are you on average, like what the holding periods?
On average, I would say 2 to 8 days, and it's really dependent upon the market, what the stock allows me to hold. So I'll go into a stock thinking, hey, maybe I can hold this for 3 weeks, but then I get stopped out, 8 days later, or maybe the very first day I think, hey, this is going to be a great swing trade. I get involved, but then I get stopped out. To me, it's about listening to the message of the market and letting the market tell me, hey, you've got to reassess. We don't agree with your timing here, so cut your loss, move on, or let the winners ride as best you can.
Yeah. And VWAP, is that something I'm pronouncing correctly?
VWAP, volume weighted average price. Yes.
VWAP. So this is something you obviously use quite a lot, I think, when you're doing a technical analysis. Is that right to say?
That would probably be my, if I had to look at a price chart and I was only allowed to look at one thing, and that would be a volume weighted average price, an anchored volume weighted average price tool.
Can you, because for a lot of people, I imagine they've not heard of it before. Are you able to explain it in a bit of detail and why you think it's one of your favorites?
Okay, because it basically says supply and demand from a certain point. Who's in control, the buyers or the sellers? The easiest way to understand what the volume weighted average price represents is if you think about a dollar cost average. If you put $1,000 a month into XYZ stock, at the end of 12 months, you're going to, 1 month you might buy 50 shares, 1 month you might buy 30 shares, another month you might buy 5 shares as the price moves up and down. So, but you're still investing $1,000 each and every month. So at the end of 12 months, you look at it and say, okay, I bought 20 shares 1 month, 18 shares 1 month. What's my average cost weighted for the volume, the number of shares I bought? So that is, it's basically a dollar cost average. When I look at it from an anchoring standpoint, what I want to do is say, okay, from an earnings report, let's say the stock gapped up, and I'll put an anchored volume weighted average price starting on that first candle where it gapped up, and I'll keep track of, who's in control, the buyers or sellers. If it rolls underneath it and sells off, I'll say, well, that looks like the sellers are in control since that event. Or I'll use it from, any type, from a Federal Reserve announcement. You'll see that it's useful. You'll see that it's useful from prior highs and lows. So there's a lot of places to anchor that volume weighted average price level to try to determine who's in control or where it might be changing hands. The buyers and sellers are kind of negotiating, and it's up for grabs. The trend that gives us the opportunity to formulate a plan around it and say, if I buy here, what's my perceived risk reward ratio, and then of course go into it and manage risk accordingly.
So are you primarily using that as indicators to buy or enter a trade rather than managing, or for both?
For both, yeah. For managing a trade, I tend to, so for my swing trades, the way I do it is I feel that one of my strengths is getting in the stock at the right time when it's just starting to move. So being that I perceive that as my strength, what I do is I get involved a little bit heavier than maybe a lot of people might in relation to the size of their account. I do that for 2 reasons. One, I typically have a pretty tight stop, or I might sell half if it starts moving against me a little bit and let the other half move to a different, less aggressive stop area. But what I do typically is I sell I sell in thirds generally. So if I'm right and the stock moves immediately, I tend to feed a little bit out. And let's say it's a $20 stock, if it moves up to daily R2, which might be 40 cents away, I'll sell a third of it at that level. And that, then puts me back to kind of a normalized position size. And I'm in it from a position of strength. because now I've taken that 40 cents out on the $20 stock, and maybe I can move my stop up to break even on the balance. So then if I stop out at break even on the 2/3 position remaining, it's still a net winner because I took that first third off. And the first third has saved me I countless times in terms of allowing a trade to pay me first and then minimize losses if it reverses quickly. So that's something I believe in big time is selling in thirds. The second third might come at a prior level of, so if we're assuming a stock long, at a prior level of important prior support, I might sell another third into that. And then for the final third, I'll try to, because I've now taken some good money out of the stock, I will try to hold it until I get stopped out in terms of higher highs and higher lows. If it continues to do that for my time frame, I'll set my stop just under the most recent relevant higher low and allow it, realize I'm not going to sell the peak, but it's going to allow me to hold oftentimes much longer than if I had just chosen some, arbitrary level or price target.
Yeah. Okay. So some of them, your trades, you let run quite a long way if the trend continues quite strong.
Yeah, if the stock lets me, basically, it's up to the stock. I want to listen to the message of the market and defer to price action. The market knows more than I do, so I'm willing to let the market tell me what to do.
And in terms of technical analysis, what do you, as well as the VWAP, what other indicators are you using? Like how your chart's set up? I think I read they tend to be quite clean because you focus primarily on the price action.
Yeah, so what I like to look at is first and foremost price action. I have volume on my charts. I have, what I really think is missing for a lot of people is using multiple time frames to say, I'm going to look at a daily chart first to kind of get the bigger picture understanding of what the trend is. Then I'm going to look at a intermediate term time frame. So let's say we're looking at a daily chart that goes back 200 days just to kind of get that feel. Then I'll switch down to a 30-minute or a 15-minute chart, meaning each candle is 15 or 30 minutes of trading. And I'll go back on that one to try to help determine what the potential risk reward is to plan my trade on. So big picture, longer term time frame is to identify the opportunity. The intermediate term time frame is to come up with a plan, and the shorter term time frame, let's say a 2-minute or 5-minute time frame, is where I can fine tune my entries so that I feel like I'm really getting involved at the most opportune time.
Okay. And so once you've decided a stock, you go through that sort of process. How do you find the stocks that you think are showing you that the most interesting or high value trade ideas?
Yeah, that's a question I get a lot. And a lot of people say, what scanner do you use? How do I do this? And, I don't have a problem with scanners. In fact, I built a scanner several years ago called the Alpha Scanner. And I built it to look at the market the way I look at it. What I found, though, was that it wasn't picking up the little nuances that I could see by looking at 100, 200, 500 stocks myself each and every day. So for me, I shuttered that scanner. It was a good product, but I just wasn't using it, so I couldn't really promote it as well because it was a good shortcut, but I've found that my own two eyes looking at a bunch of stocks on different time frames really gives me the advantage, because if I scroll through, at the end of today, I'm going to go through a list of 300 stocks, and I'll see them on 5 different time frames. I've got a weekly, a daily, a 30-minute, a 10-minute, and a 2-minute, and I can really pick up on and start to anticipate and say, wait a minute, one of the stocks in that energy group started moving, two or three of them started moving the other day. This one's looking interesting, so I'll start to anticipate the trades a little bit, that just comes after decades of looking at thousands of charts each and every day. There are good scanners out there. I don't use them, but I think that they become a little bit of a crutch to doing the real analysis.
And so, just to confirm, you do a lot of your analysis after the market closes, do you, setting up for the next day? And then you've got a watch list, have you?
I do, and actually, Ed, a lot of times what I do is I'll start my analysis for the next day in the last hour of today. So at 3 p.m. Eastern today, I might start that process. And there's a couple reasons for that. One, my head is still into the market. I don't walk away and kind of forget about the way I felt about the market today. But secondly, after looking at my personal trading results, I've noticed that I just don't really put on profitable trades in the last hour of the day. It's my weakest hour to initiate new trades, so it's a great way for me to force discipline not to trade during a time that typically hasn't been profitable for me.
Yeah. And any one day, there must be numerous opportunities that you think are potentially quite good. And do you have a process for trying to sort of rank them? And how do you choose the ones that actually you think offer the best opportunities?
So there are, again, you can look at, so when I look at a list of 300 stocks, the way I do it is I'll write down the symbols that are of interest to me. And generally it'll be about 30 stocks that I'm, have an interest in for the next day. And it's not my intention to trade all 30 of those stocks, but I want to start to, watch them a little bit more carefully, because I'm thinking maybe they're a day or two away from setting up, and I want to get familiar with them during the course of the trading day. So I'll have those on my screen, but then I'll look at my list and I'll say, two or three of them are really kind of what I'm looking for. They become my A list for the next day, and I want to focus primarily on those two or three. Then there's maybe 5 or 6 that, if we had a strong rally, it could take these, or if something happened during the day, these are the B list ideas that might work. So I will focus on basically 10 of those 30 ideas that I got from a list of 300. And even 10 can be a lot to look at. So I set a lot of alerts. So if I think a stock is going to break out beyond $65 per share, I want to set an alert, and let's say it closed at 60, what did I say, break out above 67. Let's say it closed at 66.50. I'll set an alert for the next day at maybe $66.90. So that as it approaches the level I think I might want to look at it, I can, or get involved rather, I can take a look at it closely on a shorter term time frame and say, start to get a feel for it. That's about the only time I really look at a level 2. So say how fast are the trades coming across? What are the size of the bids and the offers? And, start to just really anticipate the entry. Or sometimes I'll look at the market and say, well, the market's on fire. This thing's ready to break out. I'm gonna buy, I'm going to spray the book with market orders and try to break it out myself, and maybe other people will follow. That's obviously a little bit more risky, but that's, it depends on the market environment.
Yeah. And do you ever use orders to open, or are you just using the price alerts to signal you when, it becomes interesting to trade?
So in other words, do I have a standing order to buy above $67 per share?
Yeah.
I don't, because, and I don't think there's anything wrong with that if you can't pay attention to the market. But being full time, I'm generally in front of my screen most of the day, so I'm watching it and I set those alerts, and I feel like it gives me a little bit better advantage because I'm watching the action, and I might decide, no, I don't want that trade anymore because the market's breaking down and I set these orders, 3 hours ago. This stock's going, but I don't, I might still take the trade, but I'll do it on a smaller share size because I'm a little nervous about the market.
And how do you approach, because in stock market, there's a lot of gaps on the open. How do you approach stuff like that? Do they sometimes then, if they've already gone significantly above the point you're interested in, do you just leave them alone, or?
I typically leave them alone, or what I do is, I actually, going back to the volume weighted average price, I wrote an article for a site maybe 12 years ago, which was called Chase the Gap or Wait for VWAP. And what I mean by that was that, people chase a gap right from the open, it's up 4%, and they'll get excited and buy it, and then the stock completely caves in. Or, what I like to look for, maybe let's say it closed at 22, it opens at $23.20. It'll run to $23.40, start to pull back, breaks below the volume weighted average price. Then I'll look at it and say, if it can get back above that volume weighted average price, that's where I want to purchase it, and then put my stop below the low of the day. That often gives me a very low risk entry point into a stock where we had some kind of catalyst that ignited the stock. So it's but other times, if I'm just not paying attention or I have other positions on, I'll just let them go without me. And, I'm not going to pay up. That's something that I learned a long time ago. Don't chase those opening gaps.
And I think I've read as well that in terms of candlesticks, you prefer to just use line charts. Is that correct?
I look at candlesticks. Mainly, I switched to using candlesticks years ago because that's what everyone seems to want to look at. So for my public work, I always show candlesticks, and I've become accustomed to looking at them visually. They're just more pleasing, but I don't personally find any advantage to using candlesticks. I've never made money looking for candlestick patterns. I think they're personally, I think they're highly overrated in terms of their usefulness. I've passed my CMT exam and had to memorize all the silly little patterns, but again, I've never, and I call them silly because they've, that's my opinion, that they've just never helped me make money. People look at them as a crutch, just like they look at a cup and handle or a head and shoulders. A cup and handle and head and shoulders, it's much more important to understand the psychology of what shapes those patterns. And if I look at a candle at the end of the day on a daily chart, I get so much more information by looking at an intraday time frame than I do from a traditional candle. What's interesting actually is that my friends at TrendSpider have developed a new type of candle which combines the volume weighted average price into the candle. They call it a raindrop candle, and it cuts the candle in half, and it puts the volume weighted average price of the first half and builds a little volume profile along with the VWAP from the first half and then the second half. And you'll see often that does give you much different, more valuable look than a traditional candle will.
I had a question about a process for determining stop levels when you've entered a trade. How do you go about doing that?
So for determining a stop, what I tend to look at, and if I can actually back up to the prior question about what other tools do I use, it's price, multiple time frames, anchored volume weighted average price levels, and I use some simple moving averages on different time frames just to give me an idea of the trend. So once I have my risk reward determined, first the initial protective stop is based on what is the most recent relevant higher low for the time frame I'm entering. So I don't look at it and say, oh, I'm going to risk 6% or 3% or just a random percentage number. That's better than no stop at all. But I want to know, if I'm buying a stock as it makes a higher high on a short-term time frame, what would invalidate that emerging trend would be if it reversed and broke the immediate higher low. Definition of an uptrend is higher highs and higher lows. So if I buy the higher high, but then it breaks down below the higher low, my definition of trend no longer exists. Why on earth would I still want to be holding that stock?
And how tight are you going to the lower low? Are you on the lower low, or are you giving it some breathing room? Or
I typically, a lot of people, and this is crazy. A lot of people will go 1 penny below the low, and I'll often go 2 pennies below the prior low. And it's amazing how many times it will go 1 penny below the prior low and reverse. And I'm sitting there a penny away from being stopped out, and then the stock continues back in the anticipated direction. So 2 to 3 cents. And obviously, if you're talking about a $200 stock or a $500 stock, the increments will be a little bit bigger than that. So maybe instead of 10 cents below, I'll go 20 or 30 cents below on a $200 stock.
yeah, and why is it that? So you mentioned earlier the psychology behind cup and saucers, etc. These patterns that occur, and a lot of them are related to just support and resistance sort of levels. Can you explain a bit about why you think those work, or why do they work? Is like the psychology behind them?
Yeah, I mean, it's basic technical analysis 101, really, which is, support broken tends to act as resistance. Resistance broken tends to act as support. If people spend more time understanding that the different levels of support and resistance become the building blocks for trends, that, why does resistance broken tend to act as support? Well, as the stock breaks beyond resistance, you might get some immediate profit taking, but as the stock pulls back, what's going to happen a lot of times is people who are short will say, okay, here's my chance to get out break even. People who are, looking to get long will say, I'm going to stick a bid in there at that above that prior resistance, and it's going to add more demand to that level. So the lack of shorts, so if the stock breaks out, the shorts are going to either go scrambling or look to buy it as it pulls back to the prior support level, or I'm sorry, prior resistance, which now becomes support. So it's about, try to imagine when you look at a chart, if I just got long there, how would I feel? If I was in cash, how would I feel? If I was short, how would I feel? And how does that relate to the emerging trend? Who's in control from the bigger picture, and where do we, get that optimal entry, and then say, okay, here's where it makes sense to purchase, but then, the market's not always going to agree with us. How much risk am I willing to take? Again, set that stop underneath the most recent higher low. That's an objective level. It's not a random, arbitrary, well, it's 2%, so I'll get out, I guess.
Yeah. And so would you say there's some truth in saying that because so many people that are trading or investing are looking at the charts, even like the big institutions, it's sort of a self-fulfilling prophecy that these levels sort of work because we like looking at patterns and making these lines and stuff. Like it works with the human mindset, if you like, and it has over time therefore worked.
Yeah, I agree completely. I often bring up the example of, a 50-day moving average. When I'll do a talk in front of a group of 100 people, I'll ask about moving averages. How many people here use price action? Everyone raises their hand. How about moving averages? 90% of the room says, yes, I do. And then I'll say, leave your hand up if you use a 50-day moving average, and all the hands will still be up. And then I'll say, okay, why do you use the 50-day moving average? And they kind of look at each other and they're like, well, I don't know, because everybody else does. So what happens, we've got a stock in a strong uptrend, and it gets, maybe 5% away from the 50-day moving average. It's a little overbought. So you'll bring some short sellers into the market saying, I'm going to short this and cover my short down at the 50-day moving average, because that's generally a good place. We're 2 standard deviations above. I'm going to cover at the 50-day moving average. So they add supply, which helps halt the rise in the stock. And as it drops down to the 50-day moving average, they're sticking in bids at that 50-day moving average. So they're no longer selling stock, and they're now putting bids in. That becomes a source of demand. A large institution who has 5 million shares of this stock wants to say, well, I will sell 100,000 shares, 250,000 shares once it gets 1.5, 2 standard deviations away from the 50-day moving average. And then they'll, as they're managing their position, they'll say, well, as it gets down to the 50-day moving average, I'm going to then, let's say I sold 200,000 shares, I'm going to bid 50,000 shares at the 50-day moving average, just so the stock doesn't get wrecked, and I can, dollar cost low, at a different, lower price. And what does that do? Well, they have less supply because they were selling 200,000 shares, and now there's more demand as they stick that bid in. Then you have all the sideline traders who are in cash saying, well, that looks like a good stock. Here it is at the 50-day moving average. I was taught the 50-day moving average usually holds a support, so I'm going to stick a bid in there. So you bring sideline cash in, and you have a lack of supply, increased demand from 3 different groups: the short sellers, the longs who are longer term holders, and the shorter term traders. And that becomes the self-fulfilling aspect in that 50-day moving average area.
And so, would you say institutions, maybe more in particular hedge funds, sort of they try and attract retail traders in to support their positions at certain points that they know people are going to be looking at it?
Yeah, I think that's a good way to put it. I also think that, so like that might be a more of a mutual fund type of strategy. A hedge fund would try to, jam it down another 3% below that 50-day moving average just to scoop up shares from the weak hands. There's all kinds of little games being played, but the way I look at a 50-day moving average is just like I look at a Fibonacci retracement or a pivot level, and I say it's a level of interest. So when it gets to that 50-day moving average, I'm not going to be the guy who just blindly sticks a bid in there. I'm instead going to start to look at shorter term timeframes and look for evidence that the buyers are in fact gaining control. I'll switch down to that 30-minute time frame, see that it's starting to make lower, that it's starting to make higher lows. It's maybe finding a little bit of near-term resistance. So I'll start to anticipate the trade, but I want to wait for price confirmation that it is actually turning higher from there before I actually participate. So I want to anticipate and watch carefully in that area of interest, but I want to wait for price confirmation that says the buyers are in control and I can manage risk before I actually, commit my money to the market, to that trade.
And is there ever a scenario that you would ever consider? Do you add to winning positions? Is that part of your trading strategy, or?
Generally, it's not. The only time that I do that is if I think that a stock is, I think a lot of times there'll be a stock where I can't really figure out the exact trigger for where the momentum might come into it. So instead, I'll buy a little bit because I feel that the risk is justified, that I can buy a little bit, and if the fear, it might be a FOMO that my risk is it goes without me. So I'll buy a little bit, and then as it does in fact start to, if I don't have a full position and it starts to break a level where the momentum comes into it, then I'll add. But then again, I will sell a piece of that pretty quickly if I get it up to my full size position.
Yeah. Okay. And you mentioned earlier sometimes you do come out a third if it goes against you quite quickly.
Yeah,
only a
or
trade.
even half. But again, if I'm buying in an anticipatory mode, meaning that I don't have my signal that it's really the momentum is there yet. It's just a tester position to kind of keep me focused on it. Then I will. I'll just sell the whole thing at once if it moves
Yeah.
against me.
And where do you see people going wrong with technical analysis typically? You've obviously worked with a lot of people. Is there some sort of common things that they do that you see that they do wrong?
I do. I think that what they're trying to do is just looking for patterns rather than trying to understand the psychology of it. So just like we just spoke about the 50-day moving average, we could break down the psychology of an ascending triangle and what that represents. An ascending triangle, we have a flat top, an area of resistance. That means there's supply. Someone or some groups of people are offering supply there. But what's happening under the surface is the stock, let's say that supply is at $40. It runs from 35 to 40, and then it pulls back to 38. It runs up to 40, pulls back to 39. So what we're seeing is the demand is getting more aggressive in terms of, hey, I don't need to pay. I'm not going to wait for a pullback to 36 or 37. I'm going to buy it at 38. And then as it gets, the stock gets tighter, the supply demand, then they're going to bid 39. So you can start to understand the psychology of the pattern that's being built. Same with the head and shoulders. Understand the psychology rather than just you could train a monkey to pick out cups and handles all day, and that's not going to help you make money. Understand the psychology of it, and maybe instead of buying as it breaks above the handle of the cup and handle, maybe you buy it as the handle is just starting to move up, and you get a head start in front of the breakout traders. So you know the so in short, back to the same thing with candles. Don't just be a pattern recognition person. Understand that there's human decisions behind each of those. And if you can put yourself in the position to try to understand how would I feel if I was long, short, or in cash, and how does that group together with the different time frames, then you've got a much better advantage and a better understanding of how that pattern actually developed rather than just, again, being a monkey and saying, hey, cup and handle, I read that's good.
Yeah. And as a strategy, do you tend or prefer to get in early before breakouts rather than try and ride them as they've already broken out?
I do. So for instance, if we have a stock that on a daily time frame went from 35 to 40, we'll say, and then it pulls back to 37, and on a shorter term time frame I start to see it's flattening out, and I can buy it, let's say, above 37.20 with a stop of 36.65. I'm going to buy it at 37.20, and then that's going to be ahead of the breakout crowd who's looking to buy it as it makes a higher high above 38. So if I buy it at 37.20 and I can lower my risk, I can buy more shares because I've got a tighter stop. And as it breaks through that 38 level, I'm almost always going to sell that first third right there, because to me, the people who are buying that breakout are a little bit late. I've got a much better, and I can lock in 80, 85 cents on that first third. So if it fails, my stop will now be at break even, and I've taken some risk off, and and I'm not chasing. You always have to ask, where has it come from? And if it just ran 3%, do you want to be the guy who buys it after after a 3% rally in the course of 45 minutes? To me, you missed the boat. You're reactionary, not proactive.
Yeah. And do you typically are you playing short as well, or are you generally taking longs
I,
on setup?
I've always made more money on the long side. For shorts, I like to use. I'm better at using ETFs and the futures for shorts than I am in individual stocks. The way that the stocks, even downtrending stocks, you might be $1.50 in the money, the market closes, and then the next day it gaps up 2 points, and then it goes down $4. I mean, it's just there's too much, gappy action that I prefer long, just because it's where I've made more money as well. To me, it's a lot easier.
Yeah, no, I can get that. Yeah, it's almost more comfortable because you tend not to get such dramatic drops in a stock that's trending positively, I suppose.
A lot of people do great, shorting these micro cap stocks and that sort of thing. That's a completely different game. I think for day trading, some of the more active stocks, that's better. But swing trading on the short side can be a lot more difficult.
Yeah. And in terms of the psychology of traders, what traits do you think are most aligned with becoming a successful trader?
I think you've got to, have an open mind, be flexible, be willing to admit that you're wrong when the market tells you to. You've got to have a strong independence and be able to tune out other people's opinions. The market, there's a buyer for every seller and vice versa. So there's always going to be someone who tells you your position's wrong. The guy you just bought from told you you're wrong, basically, and you think you know more than him. So tune out the noise and have a plan and stick to the plan. Don't try to justify it. Stock goes down, so you start reading news headlines is the worst thing you can do, is saying, oh, well, why is my stock down? The question should be, why are you not out as it violated your stop? You shouldn't be scrambling, looking for news, calling friends, scouring the internet or whatever. You should be out, and those are the mistakes of that. So being open-minded and flexible, and not just getting married to your thought process is a huge thing that people need, I think.
Do you have any tips for how to avoid getting influenced by losing trades, especially if you've had like a string of losers, which typically a lot of traders will go through at some point?
Yeah, the tendency when that happens is, oh shoot, now I'm down. I've got to make all this money back and do it all at once. So you start becoming reckless. You go on tilt, as they say. You start saying, well, I need to make this money back because now I'm down this or that. I look at it and I say, walk away from it for, whether it's intraday, walk away from it for a half hour, go get your head straight, or just realize maybe it wasn't there for you that day. If it's been, a week long where you're just bleeding, examine what you're doing. Am I trying to buy dips rather than wait for evidence the buyers are coming back into it and participating with the trend? So just slow down, rebuild your confidence, trade smaller share size, not larger, trying to make it all up at once. Go for some just base hits. Get back in the into the habit of being a winner, and then start to add size and realize it's just gonna, it might take, if you've been losing for the last 3 weeks, it might take you a month to get it back. But that's part of trading. Don't look at it one trade at a time. Look at it as I'm building back on my process of winning.
Yeah. And you've mentioned previously that cash can be the best option to be in during uncertain times. Often when people are sitting in cash, you can get sort of itchy feet. They want to be in the market because then at least you've got the opportunity to make gains. How do you manage that sort of fear of missing out, if you like?
Yeah, it's totally the definition of FOMO. Hey, I'm a trader. I should be trading. What is this cash? What's going on? I need to make a stand here and make a trade because that's the only way I can get paid. But if you just listen to the market, again, it's about listening to the message of the market and saying, if the setups that you have traditionally used aren't working, well, then slow down, cut your share size in half, try to figure out what's different and preserve your capital for when either the market is back to the way that you're used to seeing the market, or switch to a shorter term time frame. Sitting in cash for a long period of time is you're not going to make money, but you're also not going to lose. You got to remember that the defense is such an important part of this game, that defense doesn't put points on the board, but it allows you to be in the proper mindset so that once conditions are kind of normalized, then you can start to participate and again, listen to the message of the market and wait. So if you're making these mistakes over and over again, it's maybe something inside your head that you're not concentrating properly, a lack of sleep, drinking too much, whatever it might be. But if you look at, the market is just getting too crazy, well then listen to the message of the market. Wait for it to settle down. It will settle down. The opportunities will be there again, and as they say, a missed trade is better than lost money. So it's a fine balance, but ease your way back into it, similar to what we were just talking about. If you have a losing run.
Yeah. And I was just going to finish with asking. We actually have a quick fire round, which is the final bit. But I just want to have one more question from the main bit. Do you think, is it institutions or retail traders that are primarily moving the market? I know that might be a hard one to.
Yeah, I mean, I think it depends on the stock and the time, but I would say generally it's institutional money that's moving the market, and a lot of that is program based, and a lot of those programs are written to trade around things such as moving averages, pivot levels, volume weighted average price levels. So if you can understand what drives those programs, or have a pretty good idea of what drives those programs, then your understanding of what makes the market move becomes that much stronger, and then you're in a position where you feel like you have more control, or at least understanding of why things are happening the way that the price action does unfold.
Okay. So yeah, so I suppose what I was trying to get to is that the institutions aren't only looking at how they can play the market, where retail traders, they know that they're going to react. They know that the market's going to react around these levels too, and then therefore they participate as well.
Yeah, and sometimes they'll try to drive it the opposite way. Back to like what we're talking about, the 50-day moving average. Sometimes they'll try to, it looks like it touched it, and the first group of people will buy there, and then 3 days later it'll break 3% below that 5-day moving average. Well, that was a manufactured break of that 50-day moving average, most likely trying to induce a fearful wave of selling. But what they'll do is they'll stick a giant bid underneath to make sure that it comes back up quickly.
And yeah, we just wanted to go into the final round, which is like a quick fire question round.
Okay.
Do we do everyone on the podcast? So basically, there's 6 or so questions, but they're not going to require a long response. It's just whatever sort of quickly comes to mind.
Okay.
I'll just go through those now. Okay, so the first one was the top tip. So yeah, just one tip for newbie traders. What could help them?
Understand the psychology of the market and yourself, not just memorize patterns.
Okay. And number 2 is, how do you wind down after the day's trading, if you do anything at all?
Yeah, I'll exercise, go for a bike ride, do a yoga class, walk the dog, stuff like that.
And where or who do you go for market insights?
I go to the market itself. To me, the market provides the most objective information. After that, it's about how well I analyze it, anticipate, and manage risk.
Okay, great. And your top tip for your younger self?
Slow down. Don't be in such a hurry to get it all done at once.
Yeah. If trading wasn't your job, what do you think you'd be doing?
Collecting unemployment? I have no idea. I guess I would be in some type of sales position, something entrepreneurial. I know I wouldn't be working for a large corporation.
Yeah. So you quite like the entrepreneurial sort of side.
Right.
Do you have a favorite charting software?
I have several favorites. I use MarketSmith from Investors Business Daily. TC2000 is a great one. TrendSpider and Wealth Charts. I have relationships with these people, and they've all implemented there are certain aspects of my analysis into them. So I actually look at all four of those every single day. I think that's overkill for most people, though.
Yeah. And finally, a top tip to keep calm in stressful situations.
Just, slow down and breathe. I had a scuba diver instructor once. He was this guy with a Jamaican accent. He would say, "Hey man, deep breath, no stress. Deep breath, no stress." So breathe, slow down and breathe.
Okay. That's good. Because a lot of people find themselves in that position. A lot of time, typically probably because they've got too much size on the trade. But
yes.
Yeah.
Agreed.
And so, thanks, Brian. Thanks for joining us on Opto Sessions. If the audience is interested in getting more insight from Brian, I think I'm right in saying you can join him on Twitter at AlphaTrends.
Yep.
And also online at alphatrends.net. Is that right?
That's right. And the book is on Amazon, Technical Analysis Using Multiple Timeframes.
Yep, highly recommended. Do you want to leave anything else with the audience before we close, or where can they access your? So these mentioned as TrendSpider, they can access one of your techniques for trading.
Sure, on AlphaTrends.net, I've got or actually on Twitter, my main or my pinned tweet, there's an article about how to use the anchored VWAP and a resources for where you can get them at the bottom of that. That's one of the questions I get most often is, how do I get the anchored volume weighted average price, and how do I use it? So that's a great place to go for that. Oh,
excellent. Well, cheers, Brian. That's been really insightful. I really enjoyed that. It's really good to dig into the markets with you. I tend to find I learn something new every time, which is brilliant. I hope you've enjoyed it as well.
I have. Thanks for having me on, Ed. A lot of great questions there, and I hope it's useful to your audience.
Cheers, Brian.
All right. Thanks.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest to you. Opto Updates is our short newsletter sent every day during a trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new podcasts, stock reports, or events from the Opto world. If you're interested, sign up using the link in the show notes. Until next time.